Hello guys! Welcome back to our virtual classroom. So it's been a while since nung last na nag-upload ako ng video.
Wait a minute! Who are you?
And kung mapapansin nyo, medyo nag-iba na rin yung itsura ko. Medyo nag-update lang yung Android, kaya ayun. Pero ako pa rin naman to. Alright, so let's talk about Statement of Financial Position or the balance sheet. This contains information as of date of its preparation about the firm's assets, liabilities, and shareholders' equity. It is an important part of a complete set of the financial statements of an entity as it provides its users a picture of a business financial position within a specific period. We can evaluate and track the financial metrics of the business entity with this document. It shows the business assets and how these assets are financed. And a business has two ways to pay for the assets acquired. Either borrow money from a financial intermediary and sell bonds, or use capital. Capital comes from investors. In case of publicly traded firms, capital comes from the sales of shares of stocks. In a statement of financial position, assets are listed on the left side. The current assets and fixed assets are combined and labeled as total assets. On the right sides are the claims on those assets, current liabilities, long-term debts, and shareholders' equity. The fundamental equation of this statement of financial position is total assets must be equal to the sum of total liabilities and shareholders' equity. Current assets are assets that can be sold or converted into cash easily. Current assets are to be used within 1 year or less. They are vital to the operation of a business as they are used to fund daily operations and to pay short-term liabilities. Typical current assets include the following: cash and cash equivalents. Cash is actual money, while cash equivalents are current assets that are easily convertible into cash, like savings accounts, checking accounts, bonds that are maturing within 1 year or less, treasury bills, and marketable securities. Next is short-term investments. Although it is good to have cash in order to have enough to support operations, too much idle cash could mean inefficient use of company assets. To avoid such inefficiency, company invest their extra cash in short-term investments. For instance, if a business has a significant amount of cash which is not anticipated to use for the next 6 months, the finance manager, with the top management approval, may invest it in an interest-bearing marketable security. Marketable securities. These are very liquid short-term investments and they are a good substitute to cash. Although the yield on marketable securities are much lower compared to other financial instruments, firms, most especially the larger ones, have them and find them very beneficial. Aside from the yield, marketable securities also serve to finance the seasonal and cyclical requirements of the firm. And there's accounts receivables. These represent products and services sold by the firm to customers on credit. Equally important with managing a firm's cash and cash equivalents is having an effective system in place for managing its receivables. Next is inventory. This includes raw materials, work in process, and products that are ready to be sold. A fixed asset or non-current asset is a type of asset that the business does not expect to sell or otherwise convert to cash within a year or the current period. Fixed asset cannot be easily converted into cash. Businesses use fixed asset to support operations and in effect to generate income. Some of the most common types of fixed assets are tangible assets and intangible assets. Tangible assets are assets which can be physically seen or touched by those who use them. Examples are plants, buildings, land, machinery, equipment, and furniture. The amount of money allotted by a business to tangible assets varies depending on the nature of its operations. Intangible assets, as the term implies, intangible assets are not physical assets. Example includes trademarks, brand names, copyright, and patents. Intangible assets help the company generate more income. A current liability is a financial obligation of a business that is due within 1 year or less. Samples are short-term debts, money owed to supplier in form of accounts payable, interest payable on outstanding debts, and income tax owed within the next year. It is best always review the amount of the business current liabilities against its current assets. On the other hand, a non-current liability is a financial obligation of a business that is due more than 1 year. Non-current liabilities are also referred to as long-term liabilities, which may include long-term debts, finance leases, warranties covering more than 1 year, pension liabilities, and deferred tax liabilities. A company may have different types of long-term debts such as bonds payable and long-term notes payable. Lastly, we have equity, also known as owner's equity or shareholders' equity. It is the actual value of funds that owners of the entity invest in the business. It is the value after we deduct the liabilities from the value of assets. Owner's equity consists of shares of stocks and retained earnings. Share of stocks are what the investors contributed to the business, while retained earnings refer to the portion of the net income that were retained after payment of dividends to shareholders in a corporation. Retained earnings may be used by the company either as additional capital or as payment for its obligations. International Accounting Standard does not specify a format for a statement of financial position that must be used. However, there are two general formats. Those are account format and report format. Account format is of 2 columns displaying assets on the left column and liabilities and equity on the right column, while the report format, often called traditional format, has only 1 column. Let's see each format. As you can see, the statement of financial position is a detailed representation of the assets, liabilities, and equity of an entity at a particular date. It also explains that all resources that an entity owns are financed through debt and equity. It ensures that the accounting equation always remains balanced. To conclude, Statement of Financial Position is a financial document that keeps up to date to the owners and other stakeholders of the company's financial standing. It is also an instrument that accountants or financial analysts use to make decision making for the business entity. I hope you find this information helpful. Thanks for watching and see you on my next video.